Hello everyone. At the outset, wishing all of you a very happy new year. Now when we look at CY24, it was a year of two very different halves for Indian equities. While the first half was characterized by unbridled optimism, the second half saw some normalization in equity markets. There was a marked change in market complexion in the latter part of the year. Sectorally, cyclical sectors such as real estate, power, auto, industrials, metals, even PSUs and capital goods, amongst others, that had been strongly outperforming in the first half of the year, underperformed in the second. On the other hand, defensive sectors such as information technology, healthcare, and consumers, having underperformed in the first half, came back strongly to outperform in the second. A similar dynamic was at play from a style standpoint too. While value stocks did very well in the first half and quality stocks underperformed, the second half saw a role reversal with a strong comeback for quality as value took a backseat. Also, from a market breadth standpoint, the breadth started to deteriorate as the year progressed, as evinced in a declining proportion of BSE 500 stocks outperforming the BSE 500 index. We believe this shift in market complexion towards a more defensive positioning has been brought about by a combination of expensive starting valuations, stretched equity market sentiment earlier this year, and a slowdown in near-term corporate earnings. The recent consolidation has been some sort of a welcome change, with some moderation in headline index valuations as measured by our earnings yield spread over bond yields, as also some easing in equity market sentiment readings on a proprietary measure. Yet, on both these counts, valuations or sentiment, we are not yet at levels denoting complete normalization of excesses. More importantly, broader market valuations stay significantly more elevated versus large cap indexes. And this you can measure through BSE 500 market cap relative to Sensex market cap. We therefore expect the current period of adjustment, normalization, turbulence, whatever you name it, to continue entering into CY25. For the long-term investors, however, the Indian equity story continues to be underpinned by earnings upcycle, the short-term slowdown notwithstanding. And on that front, India's corporate profits as a proportion of GDP have been reverting higher over the past 4 years after secularly declining for 12 years between 2008 and 2020. We believe a revival in manufacturing, rising per capita GDP in the country, and favorable demographics should be tailwinds to continue supporting a constructive earnings growth outlook over the mid to long term on the other side of the current slowdown. The current turbulence, however, should bring the focus back on fundamentals. We remain of the view that increasingly the market will become more discerning and move back towards companies which have strong business models, long-term earnings growth visibility, and sustainable cash flows. We therefore expect 2025 to be a year of significant deviation from the trend of the past few years as markets become more selective and move back to fundamentals as against the undiscriminating and broad-based up move of the past few years. We expect to continue to deliver to your expectations during this phase, and thank you so much for listening.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.